In this class, our focus is on corporate governance, and it is the second part of corporate governance discussion. And for this class, a lot of our time will be spent on discussing committee, because committee is the core concept behind the corporate governance. So committee. A number of committees are required as part of the corporate governance. We discussed corporate governance or agency problem before, which is agency problem is the cornerstone or the reason why we have the corporate governance. Is for larger company, as we discussed in another class. And in this class, we continue discussing corporate governance, but the focus is on committee. And a committee is a group of people who are appointed as to administer, discuss, and make reports concerning a subject. So there is a committee, they have a task, and this committee, the member appointed is to administer, discuss, or make reports concerning a subject. And committee tends to be permanent, have authority. So here are the key concepts behind what the functions or the characteristics. What are the characteristics of a committee? It tends to be permanent. They have the authority. They follow well-established procedures. So with procedures, and provide a way of making difficult decisions. So making difficult decisions by involving key individuals and departments. So committees should be authorized to do things by involving key individuals and department staff. So there are four key characteristics. First is it is to be permanent, and then it has the authority to do it. It has the procedures, and it needs to make difficult decisions. So there are four key characteristics of committee. And there are 6 major purposes of committees. And here is the chart showing what are the purposes of a committee. First, the committee can brainstorm. The committee can brainstorm new ideas for the organizations. It means that it is not just staff or members forming together to play game of cards or whatever. They need to brainstorm to generate new ideas for the organization to move forward. And next, the committee, one of the purposes of the committee is coordination. They allow a number of people with different skills and knowledge to work together. So in other words, the committee is coordinating different parts or different people to work together for a common goal. The third purpose is delaying mechanism. The committee can act as a delaying mechanism, especially when there is a difficult decision to be made. They need to think and consider deeply, and it is like a machine to delay the whole decision-making process in order to avoid any mistake or to minimize the risk. The fourth purpose for committee is to make or implement decisions within the organizations. As said, committee, one of the characteristics of committee is to make difficult decisions. So here is also one of the purpose of it. Another purpose of a committee is to oversee a function or a procedure. For example, public oversight boards. There's a board called public oversight boards are committees formed to minimize the risk of an organization breaching legislative requirements. So the public oversight boards its objective is to minimize the risk of the organization to breach the local law or even international law. It oversees a function or procedure for this Public Oversight Committee. And the final purpose here for the committee is to gather information. They can gather the information about a particular issue. So we have the key functions or characteristics of committee, and we have 6 major purposes of committees. And now, let's move on to discuss or to share with you what types of committee commonly used by business organizations. There are 4 types of committee commonly used by business organizations. First, Executive Committee. This is a committee with administrative powers which meets frequently to manage the affairs of an organization. For example, the board of directors of a company. We mentioned in another class about the board of directors. The composition of board of directors should be with both executive directors and non-executive directors. And board of directors is one type of committee in any business organizations. Some companies name it as executive committee, because this board of directors is responsible to run the company. And next, standing committee. These are formed for a particular purpose on a permanent basis. They have this purpose like Public Oversight Board, as we mentioned in previous slides. The particular purpose is clear, and it runs permanent, suppose, because there's a change in the legislation. There will be a change in the legislation. Then this Public Oversight Board need to look at this particular issue and advise to the company. Ad hoc committee. These are formed to complete a particular task and have a limited duration. In general, ad hoc committee is not performing one key characteristics of committee team or committee because it is not permanent. It have a limited duration. But for a business organization, there is also a need to have ad hoc committee because sometimes they have a special task or particular task to complete within a certain period of time, and other committee team cannot do it. So they need to form an ad hoc committee by inviting specialists or even experienced members to form a team to solve a particular task. Last but not the least, the subcommittee. This is simply a subordinate committee comprised of members appointed by a parent committee. This could be to look into a particular issue or as a way of helping the parent committee deal with its workload. For example, for subcommittee here, it can be a subcommittee of executive committee. The board of directors is too busy in running the business. Sometimes it identifies a particular issue, maybe on a permanent basis. The executive committee will set up a subcommittee team to help the executive committee to solve it or to look into particular items into it. So here the subcommittee team is appointed by the parent committee, which is from the executive committee. So there are 4 types of committee team commonly used by business organizations, which are executive committee here is always found in any of business organizations, and standing committee, ad hoc committee, and subcommittee. And now move on to discuss about the advantages and disadvantages of committees. First, advantages. It helps to bring together individuals with necessary skills and knowledge for a successful completion of a given task. As you see, the composition of a committee is not only one person or two persons. They are, say, by 5-6 persons with different skill sets and knowledges, so they can bring with different backgrounds of people together to work for it. Second, prudent decision-making process while poorly considered decisions are unlikely. This means that any poorly considered decisions can be stopped because the committees tend to slow the decision-making process. It uses more time for the committee members to discuss, to find a way out, or to make a decisions that is all-rounded, consider everything. So it avoids any poorly considered decisions. And third, it's also about decisions. As mentioned, one of the key characteristics of committee is to make decisions. And for decisions are easily accepted as representatives from many departments in the discussion. The decisions should have been made by a committee with representatives from many departments. It's not just one member or two members to decide in a good corporate governance structure. So here, the decisions are made by inviting different departments, key members of different departments to share their point of view and to discuss with the committee team, with committee members. So the decisions are made, are generally accepted by all representatives across different departments. Not just one or department dominates the discussion. Is the advantage of why we set up, or why the business organization needs to set up the committee. Another advantage is for the committee, the setup of committee involves a lot of people, and more people are involved in the decision-making process. It can lead to increased motivation, and the collective responsibility is found because there are many departments representatives to share their point of view and discuss and find a generally accepted decision. And no individual member of the committee is likely to be held responsible for the consequences of the committee recommendations. But because of it, there are some disadvantages from the committee. If the formation of committee is not new, so some committee members are more experienced than the others, for example, then some experienced committee members may dominate the discussion, and for the others, they don't want to share their point of view because the senior or more experienced committee members it looks like they are more powerful. And next, as said, the committee, one of the function or characteristic of committee is to slow decision-making process. It helps to avoid any mistake in the decision-making. But the negative of it is it needs to miss out any valuable opportunities, and cost of decisions are up. So here is a disadvantage on slow decision making. And decisions are made between members with compromise and fail to recommend decisive action. As members of committees may wish to further the objectives of their own departments, and they try to compromise between the various members as well. The decision made or the recommendation made is not the best, because under this scenario, it's like all members have to agree. So some members have to compromise. Even they find it's not a good move, for example, for the companies. But if they are just the minority and they would like to compromise with others and not recommend a good or the best option for the company. And the final disadvantage we share here is collective responsibility means that no one is accountable for poor performance of the committee. It reduces the members' motivation. It's quite simple and clear. As said, it's a collective responsibility under the committee. And there's no individual performance, there's a group performance. So individual members are not motivated by contributing more into the group discussion or into the committee discussion. And there are some key roles in a committee. We highlight two of them, which is very important, and they are crucial in the proper functioning of a committee. First, a committee should have a chairperson, and the chairperson is a crucial role that involves guiding the proceedings at committee meetings. We will come back to discuss what is a chairperson and what roles that he should perform in a meeting. And next, the secretary. This individual undertakes all the administration relating to the committee and supports the chair in ensuring the smooth running of the committee. So secretary is a supporting role to the chairperson, especially in ensuring the running of a committee and any meeting is smooth. So now, let's move on to see the responsibilities of chairman in committee meeting. First, the chairperson needs to keep the meeting on schedule and agenda. The chairperson must ensure all relevant issues are discussed. So no thing or no items will be missed in the discussion in the meeting. And next, the chairperson has to ensure the order of the meeting. It ensuring only one person at a time speaks. So everyone in the meeting can contribute, but please, only one person can speak at one time. So there's no conflict or arguments during the committee meeting. The maintaining order is the responsibility of a chairperson. And third, the chair must ensure all parties have fair chance to speak and express their views. So it's about impartiality. The chairperson needs to invite everyone in the committee team to speak out, to express their views. So everyone can have a fair chance to participate, so no one will dominate the committee meeting. And summing up, the chairperson say he can sum up the meeting or putting the issue to a vote and announcing the results. For example, if there's no one on there's an issue, for example, there is an issue, but not everyone agrees on the view on the issue or the actions to be taken, then the chairperson need to set a vote, need to ask the person to vote for it, whether against it, and announcing the result. The last responsibility of a chairperson here in a committee meeting is he needs to check and sign the minutes of the meeting. It depends on the formality of the meeting itself. But if it is a board of director meetings or so-called the executive committee, then the chairman or the chairperson need to sign on the meetings of that particular board of directors meeting. So let's move on to discuss the secretary responsibilities. As said, the secretary is a supporting role to the chairperson in committee meeting, and the secretary needs to do the jobs before the meeting, during the meeting and after the meeting. So let's look at what the secretary should do. First, before the meeting, secretary need to fix the date and time of the meeting. It's quite straightforward. The secretary helps the chairperson to do it, to fix the date and time by coordinating with different committee members. And the secretary need to book the venue. And the secretary need to prepare and issue the agenda and other relevant documents. So before the meeting, the secretary should prepare and issue all the relevant documents, including the agenda, and send it out to the committee member for them to prepare for the upcoming, for example, the executive meeting. So during the meeting, let's say the executive committee meeting, the secretary need to assist the chairperson in making notes, for example, and to advise the chairperson on points of procedure. So after the meeting, the secretary responsibilities include preparing the minutes, and the secretary needs to act on and communicate decisions. So after the meeting, except for preparing the minutes or in addition to minutes, the secretary needs to communicate about the decision. What are the decisions are made during the meeting? So the secretary needs to communicate with the other committee member, and also the secretary needs to deal with correspondence as well. So here we just share about the secretary responsibilities before, during, and after the committee meeting. We discussed about the chairperson responsibility, but what type or what kind of person is suitable to be a chairperson? What elements that a chairperson should proceed in order for him or her to work effectively and efficient? Let's now look at the key elements of a chairperson. The chairperson must have, first, the ability to be decisive. So he or she has the ability to make decisions, and strong decisions. Next, the person should get the sound knowledge of the relevant regulations. If it is a board of directors in a listed company, the chairperson should have the sound knowledge of relevant regulations such as the company law, the listing rules, and other regulations governing the company in the stock exchange and also in the country. And next, awareness of nonverbal behavior. That means the chairperson is not just communication, it's not just presenting the agenda or whatever. He needs or she needs to be aware of any nonverbal behavior from the attendees, from other committee members, because he should say one key responsibility of a chairperson is to make a fair chance for all participants to speak out. So the chairperson must be aware of any nonverbal behavior. For example, if a committee member is very quiet and silent in a particular board of director meeting, the chairperson should be aware of it and should give a chance for that particular person to speak out. The skill of summarizing. The chairperson should also have the skills to summarize the key points developed during the meeting. It doesn't mean that by the end of the meeting he just presents the summary, but in some particular time or in some particular point of the time during the meeting, the chairperson have the skill to summarize what have already been discussed and ask the secretary to jot notes or to write down the key points during the discussions. And the chairperson must have the skill in communicating ruling clearly but tactfully. So it means that the chairperson need to politely or use a tactical way to present some rules during the communication, during the meetings. Sometimes it can be found a person or a committee member is dominating the discussion. The chairperson now should step in by wisely communicating to the team or to the committee members that stating the rules and clearly presented the rules as well. For any person violating the rules should respect it. Otherwise, it is not fair for others. So the chairperson should have the ability to communicate the rules clearly but in a technical way. And the last elements for a chairperson must have is the ability to silence people in a firm and friendly manner. As I just said, in some discussion, it's probable to see a person dominate or a person dominating the discussion because he or she may be the expert of this particular area. So he or she dominates the discussion, and the others, for example, the others just keep silent. For a chairperson, he or she needs to step in to silence the people with a lot of talking, if in the case that it doesn't make any sense anymore, with a firm manner, but also friendly as well. So it is not easy to manage the skills to do it, but the chairperson must have it in order to make sure the committee meeting can go on or can run in a smooth way. In addition to appointing executive and non-executive directors, we just shared with you before on the appointments of them in the board of directors. An organization can have the best practice in effective corporate governance by forming two types of committee. First, remuneration committees. And second is audit committees. So let's look at each of them and see how can they improve the corporate governance in an organization. For remuneration committee, a remuneration committee is a committee made up of non-executive directors. So the key here is how can it make up, or how can it be made up? It make up of non-executive directors, which is responsible for deciding on the pay and incentives offered to executive directors. In other words, the salary, the compensation, or any other benefits received by the executive directors are determined under this remuneration committee, and the components of the remuneration committee members are from non-executive directors. It is an important principle of corporate governance that no director should be involved in setting the level of their own remuneration. As the basic principle in corporate governance is there is an agency problem. If the management, they run the business and they can determine their compensation, the conflict of interest or the conflict of interest between the owners, that is the shareholders, and the management will exist. So based on the agency problem that we discussed in another class, remuneration committee help to minimize the conflict of it, because the committee here is an independent, or the members here are appointed as from the non-executive directors, which they should be independent. And the board of a listed company should therefore establish a remuneration committee of at least 3 independent non-executive directors. For a smaller company, sometimes we can find 2 members appointed, but in general, there are 3 independent non-executive directors appointed. And the whole board of directors should be responsible for deciding the level of remuneration for non-executive directors, although the decision may be delegated to a committee of the board. And here, we would like to discuss with you on the advantages and disadvantages of remuneration committee. For advantages, first, it avoids the agency problem of directors to decide their remuneration. As I shared to you, one of the core principles behind the corporate governance is agency problem. We need to avoid it. So we have the corporate governance. And the first advantage of remuneration committee is to avoid agency problem. So that help to improve the corporate governance. And next, the board can freely make strategic decisions on company's future. So they don't need to consider or the concern about the salaries or their compensation or the benefits received. They are focusing on how to improve the company's future by strategic move. But there are still some disadvantages. As mentioned in previous slide, non-executive directors' remuneration is recommended by executive directors. So for non-executive director, their interest is still have a conflict with the organization because the executive directors have the right to decide how much of those non-executive directors will be received. So there's still a conflict. And to avoid the agency problem, for this purpose, we need or the company needs to set up a remuneration committee, and the cost involved in preparing for and holding committee meetings cannot be escaped. So there's a disadvantage of incurring additional cost in preparing it. And now let's move on to audit committee. An audit committee consists of independent non-executive directors, so they are the members of an audit committee, and those independent non-executive directors who are responsible for monitoring and reviewing the company's internal financial controls and the integrity of the financial statements. Here is the key. They are responsible for what? For monitoring and reviewing, and monitoring the company's internal financial control as well as the integrity of financial statements. The audit committee, let's see, here is the chart or the organization structure of the audit committee. It acts, because it is in the middle between the full board of directors and auditors. Okay, here they are in the middle side, and for audit committee, they act as an interface between the full board of directors and both the internal and external auditors. They should have their independent role to advise the board of directors from the opinions or comments from internal auditors as well as external auditors. So let's look at the responsibilities of audit committee. First, review accounting policies and financial statements. The audit committee is responsible to review accounting policies and financial statements as a whole to ensure that they are appropriate and balanced. So it is the first role of responsibilities of audit committee. And next, the audit committee should review systems of internal controls and perform risk management. The risk management should be within the organization, and in some cases, the risk management may be dealt with a separate committee called the risk committee. In a big organization, the audit committee cannot perform a lot of tasks, so there is a risk committee is formed to assess the risk of the organization. But in many cases here, the audit committee should also be responsible for both systems review on internal controls as well as the risk management. And next, the audit committee should agree with internal audit work agenda and review the results of its work. So they have the right or they have the responsibility to do it, to work closely with the internal audit. As we just mentioned, it is the interface. The audit committee is the interface between internal audit and the board of directors. As said, the audit committee is responsible to recommend to the board on the appointment of external auditor. Making recommendations to the board is one of the responsibilities by audit committee on the appointment of external auditor, and they have the right to determine the remuneration of external auditor as well. And the last responsibility here I share to you is the audit committee should liaise with external auditors on its independence and objectivity. And also the audit committee should review, also assess the audit process, whether it is effective or not. If any elements here, independence, objectivity of the external auditor is challenged or is in doubt by the audit committee, the audit committee have the rights or the responsibility to recommend the board to appoint or to remove the external auditor A, for example, and appoint the external auditor B or others. So here you can see from the responsibilities of audit committee, it has the main advantage that it allows auditors to report their findings to independent directors. The audit committee is composed by independent non-executive directors, and they are acting as the interface between auditors, both external and internal auditors, and the board of directors. So the auditors, they can report their findings to those independent directors before moving upward to the board of directors. This avoids two problems. First, external auditors do not have to report frauds or errors to the EDs, to the executive directors. In some cases, the executive directors, they are performing day-to-day operations. And I'm not saying all the EDs are wrong, but sometimes they make errors. And in some extreme case, the EDs make frauds as well. So the external auditors can report the findings to the independent directors before moving to the board. And for internal auditors, it is also a good way for them to voice out because they are more comfortable to report the system weakness to the audit committee, to those independent directors. And in an organization, internal auditors, if they are required to report to the executive directors, they are uncomfortable to do so because if there is any system weakness reported to the ED, and if the ED is in charge of the system, the internal auditors, they think they may have the risk of reporting to the EDs. So under this case, if they have the channel to report to the audit committee, it avoids these problems of not voicing out. So now let's move on to discuss another committee, which is the public oversight. The public is legitimate stakeholders in a large company, which means that the public has the right to know. Because a large company, they have different stakeholders, including the suppliers, customers, as well as the community that it states. It's not just the shareholders. They have different stakeholders as well. So under this case, the public oversight is important, and they have the right to know how such a company is being governed, as well as a right to be involved in the governance process. And the most obvious means of public oversight of corporate governance is via the publication by companies of their annual reports and financial statements. This will disclose a number of important matters, such as role, actions of the audit and remuneration committee during the year, as well as the composition of the board. So here, from the annual report, you can find a lot of important information. It's not just the financial statements. It includes the corporate governance report. It includes what the actions of audit and remuneration committees taken during the year, and any changes of the board composition. And most companies are required to submit their annual financial statements to any regulatory body so that any interest party can review them. If it is a listed company, they have a deadline to publish their annual reports to the public, and everyone in the public can have the right to access the company's annual reports to understand what the company is doing in the past year, and any interest party can review them. So now, let's talk another topic, that is who and why the best practice in corporate governance can benefit. First, investors or shareholders. For corporate governance, as we mentioned, it avoids the agency problem. It is the rationale why we have the corporate governance, because the separation of ownership and management. And corporate governance will mean that the investors, from investors' point of view, are likely to trust the company is being well run. This will not only make it easier and cheaper for the company to raise finance, but also has a positive impact on the share price. In other words, for those investors, they are confident about the management because we have a very good corporate governance, avoiding the agency problem we mentioned before, and the investor would like to invest in the company. For the company point of view, it's much more easy for them to raise finance from different investors, no matter they are invest in the stock or the investors would like to buy the bonds issued by the company. Because of the corporate governance, then it is easier for them to raise the finance. The corporate governance gives the confidence to the investors. And from the organization management point of view, it improves the controls and decision making, and it will aid corporate success as well as growth in revenues and profits. Because the management, they focus on running the business with good corporate governance. Say we have the remuneration committee, we have the audit committee, and we have the independent non-executive director appointed. Those independent non-executive directors, they monitor the executive directors. So the executive directors, they no need to concern about the salaries or compensation because it's already determined by the by the remuneration committee. Their focus is just on how to improve the profits or the profitability of their organization. So that's why a good corporate governance can help to improve the sales and profits as well. And for organization staff, the strong corporate governance should help to minimize waste within the organization, as well as corruption, risk, and mismanagement. For the management, their focus is not to pocket the money from the organization. They need to run the business well in order for them to keep their job, as well as to have the rights or the good salary package, which can be approved by the remuneration committee. So strong corporate governance can help to minimize the waste, because every executive director, they just look at how efficient of the company is what is running and not on the other aspects. And for the regulatory body, following corporate governance guidelines is required by many stock exchanges in order to obtain a listing. So for listing requirements point of view, the corporate governance can ensure every company listed in the board in the stock exchange have the minimum or have the same standard for them to follow. It helps to improve the overall company performance in terms of corporate governance, because it helps to improve on governing and on the business as well as the legal aspects as well. So in-class question for the corporate governance. Here, HPLC has appointed 5 members of staff to a new committee. So it doesn't mention about what committee here. This committee's purpose is to investigate a one-off failure. So it's a one-off failure on X production processes that led to a loss of $100,000 worth of products, and to make recommendations as to how H can avoid similar problems in the future. So which type of committee is this? First of all, it's a one-off failure. So you have to think whether it is a standing and permanent, because for standing and permanent, it means that the problem or the issues are regularly found, for example. Another is whether it is an executive committee. For executive committee, it means the board of directors say. So do you think it is the executive committee should handle it, or ad hoc? Ad hoc means it is not permanent. So here, standing, permanent, executive on the permanent side, say the committee is permanent, and ad hoc is not a permanent type. So what do you think? Remember, we discussed before here, we have executive committee, we have standing committee, we have ad hoc committee, and we have subcommittee as well. So which option will you choose on this question?